Hey, good morning, Tortoise Capital Weekend Strategy Report for June 29th, 2024. Let's do a quick review. We are in bullish normal conditions, longer term, strongly overbought, a slight pullback the last couple days, increasing volatility to the downside, not dangerous yet, but we are in risk-off conditions, meaning that we are poised for a large breakout from this compound critical state in which we ended the week. New holdings for blended monthly rebalancing. ETF2 increases its posture by 10% to half exposed. Regression-led fractal framework, everything is favorable. The health of the market is that RL30. The RL10 is comfortably postured. The 90 and the 270 with that little noise buffer north of 525 is still in good shape. All systems go. We are not overheated by any means. The big question is, how does the world going to process the results of that presidential debate, if at all, if it's going to have any impact? It certainly affected my morale. 3-day is postured for consolidation, as is the 9. That's a perfect compound critical state in both of these after a second leg up, 1, 2, and now it's stabilized. This one is 1, 2, and stabilized. That means that a strong move in either direction is certainly possible, more so than even normal, and there's no directional bias on this whatsoever. The 150-day look back, we're still in the top of the 150-day range. The 30-day range. We're in the middle of the 10-day range with price right here. That's why a sharp move in either direction is not impossible. I would take a breakout from the 10-day range to be the signal. So there's still a bit of a cushion inside there. You can see how good the COTA 2 moves have been after that sell-off. This SSC and then a COTA 2 a couple times. And we're well above the RL 150, or that's the VWAP of the 150 and the 30. And so all signs point to continuation is possible, but the short-term worry here is never far from my mind. We zoom into the last 30 days, you can see the anchored VWAPs. That's the first thing that I find myself looking for these days. Here's the 5. Here's the 3. So this little sell-off at the end of the day on Friday brings price below that fair value. Here's that 10-day low that to me is the line in the sand. So there's this much cushion from the low of the day to what I would consider to be the beginning of a signal to the downside. If that breaks, then the targets would be a return to the 30 anchored VWAP and the Bollinger Band mean. That would be the reversion to the main trade. It's put in one leg so far. And the same thing to the upside. I got to see something greater than the 10-day high to feel like we get a continuation play. So we are in the middle of uncertainty, and it closed weekly. That's how I read that. Perfect trading weather. The 30 period simply shows how willing people were to maybe exploit that last little burst of energy and then exiting positions for anticipating the weekend. And that was the directional move that was available intraday on Friday. This being Friday's price action. This is Thursday, Wednesday, Tuesday, Monday. And that's your 5-day range. And that's your 10-day range. Noticing the bracket formed by the high and low of the 10 days. So this was mostly consolidation, except for that one brief run up and then recovery back to normal. Tactical trading. In the blended monthly rebalancings, technology just far and away leading the way. The S&P, the Dow, U.S. mid caps, so it's U.S. dominating. When you add the sector spiders to ETF 13, you get ETF 22, and so now you notice you get XLK, and the utilities are up there, but getting smoked as defensive money is running into technology. Energy in its normal cyclic way. Russell small cap in Japan had a week, but otherwise lagging. In ETF 32, you take ETF 22 symbols, add a set of 10 more world market indices, and you get this. So now we see silver still bleeding from the ears, but on a historic run, gold in a little better posture, but tech otherwise dominating. S&P, China. What had juice this week? Energy, small caps, Japan, oil exploration. What's getting murdered? So if you're looking for weakness to short, start there. In the large caps, Apple had an extraordinary month. United Health was a significant mover. And if you're looking to pick over the bones, Nike and Walgreens certainly of interest. I look at it like this, you got a stack of symbols. You have the average, you have plus or minus one standard deviation. The ones that are extremely good might continue, they might revert to the mean. So that's a compound critical state waiting to make an exceptional move on the basis of their starting location. So I look for those kinds of signals because they're likely to continue or have a harsher, whichever way it goes, it's going to be a big move. Same thing on those that are below one standard deviation and in the red. Could be the dead cat bounce, could be a continuation of the pain and suffering. It's from these extreme conditions that extreme follow through that we can trade develops. That's what I'm looking for on these screens. And under the ETF max, so, we're looking at a couple hundred, I guess about 180, some symbols that are liquid enough to trade. These have been miserable and continue to suffer. So that's your bottom feeders, and then this is the top 30. And this sort of just proves my point that these are still in the green on the blended performance, but you're getting some amazing adverse moves, and some of them are adverse or positive large moves. And so the collapse of winners is why you got to be able to protect after a good move. You can't use that as a sign to be all is well and good to go. The abnormally good moves often get harvested. So don't be the turkey on Thanksgiving Day. All right, let's look at the regional report. There's 5 on cash, 5 on a buy. That's why we're at 50-50, up from 40-60. The strength of the market, the S&P is better than EFA. S&P is at 69. EFA is at 49. So the US is better than the globals. Inside the US, it is the NASDAQ, then the S&P, then the mid caps, then the small caps. Weakest 2 sectors, Japan and Latin America, strongest S&P and the NASDAQ. Looking at the sector spiders compared to SPY, tech and the S&P itself. Looking at the S&P against the other asset classes, gold is competing, oil is competing on a short-term basis, but not on a long-term basis. The volatility of all these other markets means that there's money cycling back and forth between here, but it cannot defeat the sustained strength of the S&P. And it's leaving treasuries and real estate far behind. So where else can you be long-term? Inside the U.S., here's the strength, the S&P and tech. Look at that concentration and focus. And then in the globals, it's all tech. So you have to see that as that's the strongest rower in the boat. And if that has a hiccup, look out below. All right, in the ETF2 summary, these are our strategies based on the color codes of strength and consistency. So silver super powerful. It's in a great posture. You can reinforce the trend. You can turbo it because winners are winning until they lose. And then the reversion to the mean is there. XLK is catching up. It's green and white. It was good, now great. You can exploit new strength. That's the new leaders. The S&P 500 in great shape. India in great shape in terms of green and white. What's losing ground? White and green. Was green, now white. That's a sign of, I'm sorry, utilities. That's a sign of a weakening defensive sector there. So at a glance, you can find the longer term strategies from this one. Looking at short-term liquidity for ETFs, looking at average daily dollar volume. These are the top 30. And then looking at ATR percentage to find the ones that are both liquid and volatile are well suited for short-term trading. Silver, Brazil, regional banks, gold miners, biotech, semiconductors. That's the one right there. Tech. It's driving the tech sector. This is the expanded table of all the ETF2 symbols that have the most liquidity. There's page one. Sorry. Page one. Page two. You can hunt through there. Back to the daily. We'll see these we've seen these before. The daily report. Short-term weakness. Risk off volatility. That is automatically a compound critical state. The winners and losers based on how far they've pulled away from or are close to the 10-day high. So you tell me, is NVIDIA, which has been crushing it, it's among the largest pullbacks from the zone 10-day high. Is that a sign of weakness or is that a buying opportunity? That's what makes it interesting and makes it a trade. You combine that with the semiconductor index, and what's more interesting than NVIDIA right now for tradability? All eyes are on it. In the Dow Tactical, you got 3 symbols that test out on the auto framer. No, that's the first thing that I look at. There's a 5DD in Merck. There's a triple screen in NVIDIA with a 2.6 to 1. It's the number one max pain range compression symbol. You can bet I'm watching that one and ready to trade it. In the ETFs, auto framers, I look for signs of bleeding, lithium, clean energy, treasuries. No other patterns. The auto framer sets up the technical pieces for sorry. There's your auto framer reward to risk ratio. It's sorted by the reward to the risk back to the 10-day high. Nike and Walgreen, some amazing numbers. Nvidia, 2.6 to 1. That's where that 2.6 to 1 comes from. There's our boy Brazil, but not a favorable swing trade in that sense. Under 2. Next one, we take that same auto framer, and now we sort it by to what degree are they squeezed. You know that's what we're doing because that's what it says. That's the criteria. Only gold. And it's favorable reward to risk ratio. Here's the S&P. I always highlight that in blue. I highlight Tesla because I'm always interested. I should start highlighting NVIDIA. And otherwise, I put the tech, Dow, small caps, emerging markets, Brazil, and treasuries to get a quick view of the most interesting large indexes. There's some energy, Home Depot and Caterpillar. Intel is on a squeeze as well. And if I'm interested in semiconductors, I should be interested in Intel on a squeeze. Excuse me. This is just the TC2000 version of the Sniper auto framer. Here's the logic of the pattern in the report. This is the explanation of what each column has. I sort it by the reward to risk ratio. The red line shows the ones that are better than 2 to 1 on an auto framer. This is how much it changed day over day on Friday. This is the size of the R10, which is 1/10 of the range stat. Here's the mechanical entry. That's 5 cents above Friday's high, 5 cents below Friday's low. That's the 10-day high. And that's how much money there is from the mechanical entry to the 10-day high. When you divide that by the risk, which is the high minus the low, that's from Friday's range, you get that kind of reward to risk ratio. 1894 divided by 311 gives you 6 to 1 on that basis. What does 6 to 1 look like? Nike on the daily. That's what a 6 to 1 reward to risk ratio looks like. You find the 10-day high. You take today's range. So if this were to open anywhere in here and then break north of that, would you take that as evidence that maybe it's going to start returning to the previous price level? If so, how many of those are there in that range? About 6. Are you going to get all of them? No. What if you get half of them? That's 3 to 1. So this is in play. Nike's going to be very active on Monday. So can you just wait and see where it opens and then put an R5 or an R10 range risk box around it and then wait and see which one breaks first? You could. Could you wait for it to break out of the range? You could. So if it opens here, you might see something like that little range box, R5 or R10, and you play the trade to the top or the bottom of the daily range. And then if it breaks out, you get maybe a second position And then how far up the retracement stack does it go? Same thing if it starts failing. You think there's anybody here waiting to get out of that thing? Probably. So that's going to be in play. So that's where this reward to risk ratio automatically lets you find things that are going to be of interest. So that's interesting. Has to be. What does NVIDIA look like? Here's the daily. And NVIDIA is at, what do you say, 2.5 to 1? So if that's where the price stabilized on Friday, a breakout from there that goes to test the 10-day high, there's about almost 3 to 1 in there. But if this breaks below, is it unbelievable that it could get back to the Bollinger Band mean? No. If it falls below the Bollinger Band mean, though, which is right near the 10-day low, where's it going to go for support? Here? Here? Or here? Well, I don't know, but if it breaks below here, I could trade it tactically to the Bollinger Band mean. And then if it continues to fail, I have 3 more targets, a potential downside move, which take it all the way back to 96. So this is a very interesting trade location. That's the yellow zone. A breakout of that is the green zone. If it breaks above this, who's going to want to be short that? Nobody. And that makes this the red zone. Phase 1, phase 2, phase 3, phase 4. That makes this a compound critical state, paying close attention to the high and low of the day as the first sign of the next move that could occur. Yeah, I can trade inside this range, but I have to have 2 to 1 inside of the tight risk box to justify that trade, because those highs and lows acted as boundaries. What if it gaps outside of that? Then it's in play because it's a gapper. If it closed here and then here's the high and the low of the day, but it gaps up here or gaps on there, that's going to be a big gap. That means this would be in play, and then I can put my bracket on that and play the breakout or the failure simply on the basis of the information that there was a large gap, and then let the rest of the day unfold as a tactical day trader. That day trade may lead to swing trades that take it all the way up or down to these other targets, but that's another time frame. They're connected in time because price is continuous and connected, but that's how trends and momentum work. That is advanced hybrid swing trading. Four seasons of MACD still being dominated by summer and spring and general good feelings. But there's a few things that are falling or the winter. So they're interesting for that reason. I mean, Apple and Microsoft as rebounds in tech are possible, and Microsoft is winning that race right now. Interestingly, nothing in the ETFs is in winter. and you have some real clear winners here. I like that the the Qs have made a slight pullback in the fall. That's this and a pullback. That's what you get. Is it going to rebound? Yeah, it could. You got to watch to see, does it break the previous peak of the RL10 for the real clear confirmation signal? This is looking at the NDXs, and this is trade location based on the look back periods. Oh, yeah, that's right. That's what I said here. That's how bad Nike's move was, the explosion compared to the previous 2 days. What's winning? ExxonMobil, US Steel, Cliff Natural Resources, and JP Morgan. I'm sorting it based on the 10-day NDX because that's the swing trade time frame of interest for me. Treasuries and utilities getting murdered. Small caps, Japan, and regional banks. I'm interested in small caps on this basis. And I suppose the mid caps too. And finance making a run along with JP Morgan. So if finance starts going up, you better go look at JP Morgan. So how do you set up a chain trade on that one? If the S&P is up and if XLF is better, then JP Morgan could be the leader. And if so, you pick him. But if he's not better than the XLF, but XLF is better here, you pick him. Target lifting and shifting. We're just watching the herd. This one gives you the frog list, trading values, the big jumpers, sorted by, this number comes from the TV ratio, which is when you take the average range percentage and multiply it by the frog quality number. This one times this one gives you this one, and then you rank it according to that, and you get the top 10. These are all liquids, so marijuana, Tesla, Nvidia, clean energy. That's interesting. Pfizer, Travelers, Goldman, Boeing in the news still. Nucor Steel quietly getting it done. Thirty-day regression line. This is a slight variation of where's the shorter term momentum. That's the polynomial version of that. But the slope of that 30 period line, that angle, alpha, tells you how strong the current move is. How does that compare historically? Well, here's what it looks like on a Z-score basis over the last 30 days. It's better than average, and average is better than the long-term plus or minus zero line. That's when the slope gets negative, is under the dash line. That's a full standard deviation away from the zero line. So this is a strong move, not abnormally strong. It's only about Z.5. This is the long-term path of that Z-score. It has pulled back. It's still above average, and average is above zero. So that's a bull market. Here's how far that S&P is stretched away from the 200-day moving average. It's a full standard deviation above. So the last 30 days have been pretty strong. Everybody holding their breath from that presidential debate, in my view. bring the slopes, the z-scores of 3 different regression line slopes compared to the last 180 days for S&P. This explains what we're doing. This is the price river, and this is the price. It's outside the river and grinding north, which we can tell that the RL90 slope is up and getting ready to become resurgent. The RL30 slope has pulled back, flattened out, is ready to become resurgent. The 10-day has suffered a 2-day pullback, but it's still in favorable. If it turns on Monday, then a turning 10 will give strength to those, and the bull market will resume. So we're at a pretty favorable, almost Cotta 2 style of a state, and the last move was favorable, and so was the move before it. We've had one negative move inside this whole positive move. So we're in good shape for continuation. The reversion to the mean is always there. And I'm going to protect the gains that I've made in here, particularly as we start going towards the big E, the election. All right, that's everything from the weekend report and Friday's daily. Let's go take a look at some tactical trading from Friday. EWZ, 10-minute. Here was the gap down. Here's the OR10. Here's the breakdown. Sells off. Here's the turning point of the R10. There's an exit that captures an R. There's a 1, 2, 3 entry. There's the R10 rolling over. There's the dragon exit. There's the entry when it leaves the dragon on a 1, 2, 3 that way. There's the turning point. I take the skin of the dragon. I try the breakout. It scratches. It drops below the VWAP. I try one more, and it gives me a little bit. So reasonable intraday harvesting on Brazil. Same logic on NVIDIA. There's the OR10 after yesterday's close. There's the entry. It runs up. Here the R10 is stalling. I want to capture a 1, 2, 3 exit for an R. I short it when it crosses the VWAP. It scratches, goes nowhere, doesn't even break above the skin of the dragon. It fails. There's a collapsing dragon. Hey, what if you take that? Okay, you exit there. There's a price capture. There's a re-entry on a speculation that scratches. You see an idea, trade it, manage your risk. If you can see 2 to 1, trade it, manage your risk. Let's see. That's NVIDIA again. Okay, this is already showed Brazil, sorry. Here's US Steel. There's the OR10. This was a higher low and intraday strength. It's a 1, 2, 3 entry on 3-minute bars. Hey, what if I wait for the OR10? Then I get an entry there, and my stop is like that. If you see a 2 to 1 and you want to take it, take it. Manage your risk. Here's the turning point. Manage my exit at the skin of the dragon. I take the PSAR flip, so it gives me about 2 plus 1 is 3. Friday's traders. Really? I had these all queued up, but it must have crashed. Bear with me. These are all of Friday's trades. I just go to the thumbnail, right mouse click, open in a new tab. I asked Brian to produce a analytical report for the first 60 or 70 trades in what he's been doing, which looks pretty good. Here's Tim. This is AMD, 3-minute charts. Yesterday's VWAP. He takes essentially a COTA 2, standard risk, plays it from here, takes the PSAR exit for 1.6. He shorts it when it crosses the VWAP, standard risk, takes the PSAR exit for 1.4. Oh, I guess this was 1.8, sorry. And collects 3.2. M. He brings in a total of 0.8 on 3 trades. Gets the first one for 2.5, tries a continuation, it cuts it, tries the re-entry, cuts it, minus 1.7, plus 2.5, net 0.8. There's all the framing data that he uses inside TradingView to set up his charts in the standard way. Hamad, minus 0.3 on the Dow, probably got ground up a little bit here. His position size, he notes, may have been large, which made him maybe a little nervous. Yeah, that's a sign of maybe too much size, making you skittish. EWW was not in play. A couple reasonable shots. Didn't take the last one, talked himself out of it. Headed out to dinner, but he makes up for it in Brazil, getting aligned twice, 3 times, 4 times for 3.6. So 2 out of the 3 were not really helpful to him, but the one that worked enough that he gets his daily. Here's Brian continuing to do the good work. Tries to short at the PSAR break. PSAR to PSAR for 0.7. PSAR to PSAR for 1.7. Making that look pretty simple on the British pound US dollar on 5 minutes. I don't know. This is his, he's got an expectancy of 0.67 over his last 30 trades. He's 70 trades into that exercise. Pretty boring. Not exciting. Maybe this one will be exciting. No, not really. It's a emerging dragon. I know it's an emerging dragon because he identified it. Takes the PSAR exit for 0.4. Gets a COTA 2 entry. I know that because he identified it. Identified his risk box. He decided to cash that one for 3.1. And this is gold spot versus the US dollar. His expectancy over the last 30 trades is 0.89. Not bad. Boring. All right, guys, that's everything for today. We'll get this published and posted. Take good care.